Okay, good morning once again, ladies and gentlemen. Welcome back to class 2 of our internationally accredited program in risk management. Before we go ahead and begin, I want to go ahead and just clarify the schedule because I had a few emails and calls this week as to regards Wednesday's classes. So I'm going to go ahead and put up the schedule. As you can see, we don't start Wednesday classes until May 18th. Our first 6 classes are Saturday mornings. The reason being for the time zone, as our first 2 lectures are from the United Kingdom. So we will start our first Wednesday on May 18th. At 6:30 p.m. Eastern Standard Time. Okay, now this weekend is a Easter weekend, so we won't have class coming up this Saturday, but we will have class. Class will continue the following Saturday on April 23rd. Okay.
Miguel, we have 3.
Yes, we have 4 new 4 persons added to the class. So we want to go ahead and ask those persons to just briefly introduce themselves. We can start with Mr. Kevin Turnquest.
Right. All right, good day. My name is Kevin Turnquest. I'm an accountant with the National Insurance Board, located in Blue Hill Road. I saw the advertisement on the on Facebook, my favorite place to be on my off days, and I was very intrigued about it. It seems the course is very, very in-depth, more so in-depth than what I've been seeing before. And the content's really, it seems applicable to the overall way in which the economy is going. I think fraud, risk, and all those things really are just bread and butter topics which every company needs to have in their repertoire. So I'm looking forward to being a part of it. The course seems extensive and lengthy. I'm ready to roll.
Excellent. Welcome to the course. I think someone else must have the mic on at the same time.
Yeah.
Okay. Thanks for doing this.
Okay.
Could we go on to Miss Kenesha Davis?
Hi, morning.
Morning.
My name is Kenesha Davis. I'm from St. Kitts. I work at the Development Bank of St. Kitts and Nevis. I just want to take this course to help in my professional development.
Which bank did you say you were at?
Development Bank of St. Kitts and Nevis.
Oh, yes. Well, welcome very much to the program. We had the Caribbean Association Banks conference at St. Kitts once. It was a few years ago now, I think. Possibly about 4 or 5 years ago. Yeah, welcome to the program. Thank you.
Okay, can we go on to Ms. Shanta Louise?
Thank you. Good morning. Can you hear me?
Morning, Shanta. Yes, we can hear you.
Okay, good morning. I am from Bank of St. Lucia. I am currently the head of risk and compliance. I saw the program advertised, but I thought it was, the content seemed very appropriate now to update my knowledge of risk and compliance. I worked to Central Bank prior to being in risk at Bank of St. Lucia. So I look forward to all what the course has to offer. Thank you.
Yeah. Well, welcome. You might just see over my shoulder there on the wall there. You can't see it too clearly, but that's a picture of the Piton Mountains in St. Lucia. Yeah, my other pictures are down at the moment because we're just redecorating the office. And last evening, I don't know if you've heard of the lady called Jane Mcdonald. You probably haven't. She used to be a singer on the large cruise ships, and more recently she's done some reporting on television, and she's doing a series visiting Caribbean islands. Last week was Barbados. I didn't see that, but last evening was St. Lucia, so that was really nice. They were staying right at the north of the island, and then they went down to Rodney Bay, then down to Marigot Bay, and then they took a catamaran ride down to Soufriere
Oh,
and showed
lovely.
the sulfur, well, it's dormant now, isn't it? The dormant
Yes, it is.
volcano. Yeah, and then they showed pictures of the pitons. So next week she's in Antigua. I'm not sure if she's going to get as far as some of the other islands that we got present. Thank you.
Okay,
Yeah,
I look
yeah.
forward to seeing it.
Yeah.
Yes, yes, thanks. And we have the last Miss Vonette Saunders.
Coming back to the playlist.
There we go.
Hi, good morning. My name is Bonnet Saunders, and I work at IPG Family Office. It's a small boutique family office here in the Bahamas, and it's basically wealth management. But I'm interested in the course because I'm new to risk, and the way the world is going right now, it's best to gain more knowledge about it.
Excellent. Yes, thanks, and welcome to the program.
All right, thanks. Yes, so that is our four new persons. Oh,
No.
Joe joined us.
So have we not missed somebody, Miguel?
I'm looking over the. Hopefully, I don't know. Have I missed anyone? No, I don't think
No.
so.
Okay, fine.
All right. So I'll let. Okay, Mr. Jackley, I turn it over to you. You have the controls.
Let me try sharing my screen.
Okay.
No, it's not giving me the authority yet.
Progress.
Okay. Can you open the chat box, Miguel?
Yes,
I'm not getting that. Okay, I've got it now.
Okay.
Okay, so
Hopefully, I think I've sent the documents to everybody. Hopefully, they got the case studies. I forgot to ask.
Well, if you didn't, you can see the three for today are actually in the chat box, which you can see on the screen. One's an accident waiting to happen, Bearings Bank case, and a very recent one, which just happened very, very recently in the UK, National Westminster being fined. So that's really a stop press situation. Can someone confirm that they can see the screen with the Basel II summary chart, which is where we got up to last week?
I can see it.
Excellent, thank you. Okay, so last week we started on our journey of this complex topic, and I explained within module 1, the 3 presentations I'll be doing. We're focusing on taking a wide macro perspective of enterprise-wide risk management, and then you'll see the way the program's been designed and run successfully for quite a number of years is the modules, as they progress, they then take subject matter which fits into the enterprise-wide risk management concept, but then they go deeper. So for example, the module 2, for example, which will be my co-delivering out of the UK, talks about credit and operational risks. And then you'll see the various other modules, investment and liquidity risk, market risk, regulations and compliance risks. And the final topic, which is very, very important indeed, as some of you have mentioned, the way the world's moving at the moment, and that's reputational risk and corporate governance, the way these large corporations should be managed from a board of directors perspective, and of course, the banking industry guidelines that we'll see appropriate to that. So we're at the moment on enterprise-wide risk management, and we began last week by looking at a definition of what it was, and we'd see, the sort of galaxy of risks that we're facing. Some will be known and expected based on our experience and our track record of experiences. And we recommended, as we've been doing for many years, the build-up of this risk event database, so you can see going, more work related for yourself, the type of risks that you could be facing in your organization. And then, of course, the problem will be the unknown risks, and the Basel Committee recommend additional capital reserves, as we'll see, to look and be ready for some of these risks. And we're going to talk about some actual case studies in a few minutes. So just recapping on that Basel II back from 2004 came out as quite a surprise in terms of the extensive nature of it, and the documentation. I gave you the reference www.bis.org, and you can see that's the Bank of International Settlements, which is the central bank's central bank. And from there, you can pick up, lots of these Basel publications, and we'll give you quite a lot of references during the program, which we hope will help you in your knowledge of the topic, and also help you, within the jobs that you're actually doing, or the jobs that you're hoping to be progressing to. So the Basel II strategies were for the establishments of 3 pillars. We discussed this, it could have been departments or divisions. Sorry, I don't know quite what happened there. Pillar 1 was the mathematical side, looking at the capital strategies, and that's quite a complex mathematical approach, suitable for those who are, working on the treasury side. But as risk managers, our job is to make sure, that people are doing what we think they should be doing. There's one new message just come in the box. Let's have a look. Oh, good morning. Yeah, good morning to Dimitri there. And we need to be sure that the persons in the different risk departments are, doing what we think they should be doing, and also taking note of the international best risk management practices. But having said that, the international risk management practices will be reviewed, adopted, adapted by your own central bank, and they will be giving specific guidance, just as we saw last week, where some of the persons participating very kindly gave us the reference to some of the Central Bank of Bahamas guidelines. That was excellent and very helpful. So we'd see under Pillar 1, the mathematical side of credit risk, market risk, and operational risk. And as I said, Module 2 will be looking at credit and operational risk. And then a bit later, you'll have the market risk in depth. But just for the moment, you can see under the credit risk, for example, there are 3 approaches. Now, this was quite unusual in the innovative package of Basel II, and the committee created choices, but all of the choices, I have to say straight away, need to be accepted and signed off by the central bank. So you can't just, put your own institution, for example, under credit risk, right into the advanced internal ratings-based approach, which you'll get a lot more of in Module 2, without the agreement of the central bank supervisors. And the same with market risk. The market risk methodology primarily revolves around value at risk, and you'll have a lot of that in the market risk module. And then operational risk, you can see there are three methodologies there. There's the basic approach, standardized, which is a kind of hybrid of putting some of your own measurements in and then using some of your own central bank measurements. And then the top level is the advanced measurement approach. Now, when this came out all those years ago, I think their expectation was that quite a number of the larger banks would definitely get on to the advanced measurement approach, but this has proven very, very difficult indeed. And if I just kind of draw breath for a moment, the reason for that, and I think you'll agree, is operational risk is really, really difficult because it can be, you know, a very small event, maybe like a teller, you know, taking some cash out of the till, or it could be something right at the opposite end. It could be a huge fraud, you know, which is going to impact the bank, or it could be, you know, one of the external events that we'll see within the Caribbean in particular. So the actual methodology and scope of being able to look into the operational risk will prove very hard. And we'll see from some of the case studies that some of the operational risk events, you know, they can have quite a catastrophic effect on the institution concerned. Then we talked about the supervisory review, which will affect a lot of people on this program, and the role of compliance there, making sure the compliance with Pillar 1 is on those sections there, and then Pillar 2 compliance in terms of making sure there's a risk culture, there's good risk management with the appropriate compliance and processes there, and then procedure manuals, etc. And then the important area of this building up of this database. And the Basel Committee recommend a minimum of 3 years data collection. So just picking up on that Pillar 1 mathematical side, just summarizing it so you've got it quite clear. And again, there'll be more of this in Module 2, but you can see under the credit risk, there's the three choices there: standardized basic approach, and that's the successor to Basel 1, which I mentioned last week, which was as long ago as 1988. And then there's the intermediate, where the recommendation's been for many years now, and lots of institutions have developed this, some type of internal rating based approach on the credit portfolio. So I'm going to put a question in here. So internal . Does anyone want to contribute on this internal ratings aspect? Someone from one of the larger banks? We could possibly put Chantal Louise on the spot from St. Lucia, since I worked as Bank of St. Lucia over 20 years ago and many, many times. So hopefully you've got some type of internal ratings-based approach there.
Well, good morning. So
Morning.
I know locally
Dimitri,
what we usually do for internal rating is we base it based on the customer's character, credit history, capital, collateral, how long the customer has had a relationship with the bank. We use these 5 aspects to get an understanding of how great the risk is, and it's based on in reference to three levels: low, intermediate, and high. And based on where the customer lands, they would garner an internal credit rating, and based on that credit rating, it would determine the level of exposure the bank is willing to take with that particular customer.
Excellent. That was very clearly explained, and I can see, I think you said 5. So the original, yeah. We had lovely feedback there, and yeah, the 3 C's was the original credit mnemonic, you know, from many years ago. standing for those aspects that you've just been mentioning there. Anyone else want to contribute, and then we'll just move on? Anyone got something quite different to what Dimitri just mentioned?
I would just add that
Yes.
we're currently in the process. The central bank is currently moving towards Basel II.
Right.
So we have a hybrid of Basel I that the banks in the region use for now.
Yes.
So really now it's a process where central bank is engaging the licensed financial institutions towards the revision of to be applied.
Excellent. Yeah.
A draft.
Thanks.
Yes.
Yeah. Thanks, Shanda. So that's kind of work in progress, and it sounds as if you're heading towards that intermediate box there, where you'll provide some of the ratings data, and then the central bank will give you extra guidelines on the categorization by way of their input. Thank you. Anyone else want to make a comment? Then we'll move on. Anyone on the advanced ratings approach, where the advanced ratings is where the financial institution does everything, and you rate every credit, and then that rating process has got to be reviewed and agreed by the central bank. So you've got this, the basic approach, then you've got the hybrid one we've been talking about with inputs from the central bank, and then we've got the advanced one where the institution will push forward. But more on all that in the credit module, so we'll continue. And then the operational risk, again, Mike will be picking this up with you, but three basic indicator approach, the standardized approach. I'll just mention this briefly because it's very, very important in terms of risk management. So what the Basel Committee encourage is the splitting of your activities within your financial institution into the recommended 8 business lines that they recommend. Now that's very, very useful, because if you don't know where to start in terms of looking at the risks within the organization, it's quite a good idea to take what Basel have developed over many years, and then if you work your way through the 8 and you'll get the definitions of the 8 categories, then there'll be some which you'll say, well, that one's not appropriate to us. That one is not an area of activity we do, but it does give you a very useful starting point. Now, we looked at this last week when we progressed towards Basel III, and you've got the handout to look at, but in summary form, using the 3-pillar approach again that I was using on Basel II, you can see pillar 1 is enhanced minimum capital, as we were saying, and the liquidity requirement because of the things that happened during the global crisis. And then pillar 2, you can see, is enhanced supervisory review. And here they're introducing the words firm-wide risk management, and also looking more carefully at internal capital planning, linked to the risks that you're actually seeing in your organization. And I mentioned, firm-wide is the same as what we've been talking about in terms of enterprise-wide. Then pillar 3, which is the directors, remember, making disclosure to the marketplace, being transparent and telling the shareholders, etc., what strategies they have for risk management. And you can see again, it's an enhanced process. So this is why it's so important that we get a reasonable understanding of Basel II, because Basel III builds on top of Basel II. So you can't just kind of ignore Basel II and then move straight to Basel III and make sense of it, because as you can see, it's enhancements to all of those 3 pillars. And then last week we looked at the chart, looking at the key aspects of a leverage ratio being introduced. I'm going to come on to that in a moment. Liquidity ratios coming in because of the liquidity crisis that we saw during the global crisis. And then the minimum capital requirement being pushed up to 10.5%. And I explained my experience within the Caribbean is lots of organizations in the Caribbean will be carrying more than the minimum recommended at 10.5. and this was confirmed by the central bankers on our program in Bahamas. So then I won't go through these slides here because we went through this last week, but this is important, that the mention of the systemically significant cross-border banks. Now, these are known as SIFIs, actually, systemically important financial institutions, and you might want to make a note of that. And you could search that yourself on, by Google or whatever, and you'll see there are approximately 30 to 35 listed globally institutions. Some names you'd expect being there, some you might not be expecting. There are now 2 large Chinese banks in there, including the Bank of China that we've done quite a lot of work with over the years in London. London is the central training office for the Europe and the Middle East, and they'll be listed in there. So these are systemically important financial institutions. And again, the Basel Committee recommend that these institutions, because they're so systemically important, they should have an extra layer of capital on top of the capital requirements that we've been discussing. So there we are. So let's go on to some highlights of things that we've seen. I've only picked a few out. You'll know of some incidents that I don't know about, etc. But I picked out some that can show the impact of these risks and why it's so important, as a lot of you have mentioned in your own personal introductions, and the gentleman from the insurance company. We'll see a bit later on the convergence between financial institutions, insurance institutions, and other aspects, trading in securities, the securities regulators, IOSCO. So the 3 of them coming more together. And I mentioned last week, in terms of insurance, we're talking about Basel II, but in terms of insurance, you now have Solvency II, which takes a similar 3-pillar approach to what we're talking about. So here was a shock to us in September 2011. Now, it was a shock because it's UBS, the gigantic Swiss bank. And those of you who know something about Switzerland or something about Swiss bankers, generally they're very, very cautious indeed, and they have extremely good control systems. Now, the London office, where this rogue trader, Kweku Adoboli, well-known English name, that's a joke, by the way, was arrested over a $2 billion US loss there. And this was a very, very big surprise to us. The UBS in London, it's a huge, huge building employing about 600 staff there. And interesting how this came about. And the gentleman who joined us this morning mentioned from the insurance, mentioned about social media, and how this was discovered was actually through social media. So what happened over the weekend, going back in time there, over that weekend, the manager of this particular department saw an entry by Kweku on social media, and the entry was this: "Only God can save me now." Now, as a risk manager, as we discussed last week, we're looking for things that's unusual, that can be unusually good or unusually bad. Now, here's an unusual statement, you would think, and bearing in mind this is a trader, so immediately the manager was quite worried about this, and on the Monday when they all got to the office, they closed the trader's books down, and this loss was revealed of approximately $2 billion US. I mean, that's an absolutely huge figure. 31-year-old trader, cost the bank, well, approximately $2 billion. The bank said in a statement, UBS has discovered a loss due to unauthorized trading by a trader in its investment bank. The matter is still being investigated, but UBS's current estimate of the loss on the trades is in the range of $2 billion. Now, you might be wondering, well, how on earth could that happen? And that's what we were all wondering as well. Now, what happened in this particular case is that the gentleman concerned, he'd actually worked in the back office controlling section. And then when his job was changed to the frontline section, what did he do? Well, he took with him the authorization codes for transactions. Now, if personnel department, if HR department had looked a bit more closely at his personal background, they would have seen that this man was a notorious gambler. So he was always gambling. And then, of course, when he got into the front office, here was his perfect opportunity not to gamble this time with small amounts of his own money, but this time to gamble with the bank's balance sheet within these trading activities. So that's a real shocking case there, but it goes back to some basic control issues. And this is what we find time and time again, that some of these incidents, although they're complicated in their nature, time and time again, they go back, to basic things that you expect to be in place. So that's really, really important to always remember if you're looking at a very complex risk case, try and get down to the basic understanding of what's going on and what the risks actually are there. I don't have a slide on this, but continuing from that, and again, what quite often happens, the trader himself, he blamed his manager, and he said his manager was quite happy. Yeah, good question there. What about employee background checks? Was this done? Well, I can only presume because, of course, we can't get access as individuals to the personnel file of him. So one would assume that the normal background checks were done, but obviously, to answer your question, they weren't done sufficiently in depth to pick up his style of personality. And as Dimitri mentioned earlier, maybe the bank should be doing more of the kind of character checks that he mentioned when they're looking at their credit portfolio. So very good question. Yeah, what background checks were done? So he blamed the manager, and he said his manager was very happy with his trades when he was making profits. And then, of course, as soon as he made losses, straight away, that should not be there. So a question from Dimitri, for that amount, shouldn't it take two persons to authorize? Most definitely. Yeah. I mean, that's most definitely. Yeah. And the question is, it's not that it's two persons to authorize, because if he's got the codes, of authorization from the back office, he's manipulating the system, isn't he? Now, there's something else that should be in place that you might want to think of, Dimitri, that could prevent the large amounts. What sort of things? So let's imagine just for the moment we're risk managers, and we're in UBS all those years ago. What should we be introducing to stop this possibly happening again? What additional controls should we be building in as a recommendation as risk managers? Anybody want to have a stab at that? You can either do it by microphone or a trigger event. Yes. What do you mean by a trigger event?
It would automatically involve or update, I would say, senior management or credit risk management or even directors if a transaction is taking place that's over a certain threshold.
That's
so
what we want.
Threshold in place,
yeah.
Putting a threshold in place for each employee where they can only approve a certain amount.
Yeah.
And if it goes over that amount where they do where they do an authorization themselves or override, it automatically triggers and updates somebody else.
Yeah, so I'm just confirming that. I've put in risk limitations, yes. So there'll have to be thresholds built in, proper thresholds built in, that when they get to a certain level, that's it, it's closed down. They don't have access to continue. So we need much stronger controls in there. Anyone else?
So I to what Dimitri would have said. This is Donald. What I would suggest would work in this instance to prevent that particular mischief would be to ensure separation of duties at all times.
Yeah.
So when the gentleman would have changed department, there has to be some mechanism in place to capture persons like that so that they don't carry forward the old access.
Definitely.
So say quarterly or every 6 months or every month based on the frequency of movement between departments.
Yes.
If you implement a process whereby someone independent would check the credentials of persons who actually have access to systems and determine whether they need those access for their current role. So if they were to have done that, they would have realized he had two sets of access and they could have canceled one access point.
Yeah,
yes.
Very, very good.
Yes,
Good
I agree
thinking.
with that. Hi. Yes, I agree with his comment as well, because when you're moving from back office to front office, you should no longer have authorization.
Exactly.
Exactly. And in terms of thresholds, I agree with Dimitri. In terms of blocks, you should have blocks in place. So at the end of the day, you should only be authorized a certain amount. And I think senior management should be the one to authorize, I guess, a certain level, a certain amount.
Definitely agree, yeah. So we're getting some really good comments coming in there, and it's just so surprising, as I say, with such a large organization as UBS, one of the largest banks in Europe and in the world, where the controls were actually so weak. So plenty things to think about there.
Okay, also, in terms of the detection, I think when people are making money, everybody's happy. When you're making losses, everybody's sad. So I think it's the same protocol should happen when you're making a lot of money. You should be investigating exactly why this man making so much profit. Using that as a trigger event also, not so much as losses, but why this person generating so much profit. That should be a risk factor as well.
Definitely, and I did hope to say that last week. I'm not sure if I actually did. I think someone's mic's still on. Yes, as risk managers, we want to be aware not only of bad events, but things that are really good, because we all know in business, it's not that easy to make, really, really outstanding results. So if you see an outstandingly good result, we're not going to try and dampen people's spirits, but we do need to be looking at that to see how they managed to achieve this extraordinary result, because it might actually be something rather nasty underneath. So very, very good comment there. Established KRIs, key risk indicators. Does that stand for? I'm just guessing. Yeah, so interesting opening case. Yes, thank you. Key risk indicators. Excellent comments coming in. Now here's something totally different, and this comes right back to Caribbean, to the lovely island of Antigua. And those of you who might remember this, this is Stanford's investment bank, housed in Antigua. And unfortunately, he perpetrated a huge scheme, a Ponzi type scheme. Does everyone know what a Ponzi scheme is?
Yes.
We've had quite a few of these, the Ponzi scheme. Yeah, Kevin says an illusion. Yeah, that's pretty good actually. Yeah, well, just giving you the basic idea. Madoff as well. Yeah, Madoff. Yeah, Madoff was a Ponzi scheme, but a much different style approach. So let's talk about this briefly. So the Antigua scheme was small investors, and lots of them. The Madoff scheme was where he set a benchmark. You know, you had to show a personal net worth of $500,000 before he would allow you to invest in his scheme. So that's a very interesting starting strategy. And of course, the way Ponzi works is that there's a basic investment, and then someone such as Madoff or Stanford would promise to pay you because they're such good investment managers, they're going to outperform the marketplace. And because they're going to outperform, they can pay you a higher dividend or whatever on the investment you've made, you know, with Stanford or Madoff, using these two examples. Now, what they then rely on is not just word of mouth, but news, etc., that the scheme is really good and they're providing, you know, above the marketplace returns, in the hope that new investors will keep coming in. Now, the reason they want new investors is simply because they're only achieving actually the market returns, or they might be achieving under the market returns, but they made a promise to pay above the market returns. So what they need is new money coming in. So for example, if Miguel had invested in my scheme, for me to pay Miguel this extra premium on his investment, I need a new investor. So I can see Chandra on the screen there. So if Chandra invested in the scheme, I can use some of her investment to pay Miguel his extra. Now, the next problem I've got is I now have to pay both Miguel and then have to pay Chandra the extra. So I'm hoping someone, you know, like maybe Darcy or Kevin will come along and or Dimitri, and they will be happy to invest in the scheme. And that's how it works. Now, it'll keep working as long as there's new investment coming in. But when new investors get wary of this, this is when the problems occur, because there isn't the funds there, as we saw in Antigua. And the trial in Houston, you know, they said he'd been doing this for about 20 years using investors' cash, and his bank eventually collapsed. And you'll have seen the people, particularly in the Eastern Caribbean section, seen the reconstruction of the bank to form ECAB, the East Caribbean Amalgamated Bank. And I did actually do a couple of programs there after the reconstruction in Antigua. And you can imagine it's still a very difficult recovery. So Chandra Louise says, as long as most investors do not want their money withdrawn at the same time too. Yes, exactly. Because again, it'll be the same problem. It will be a liquidity problem that hits. Now, Madoff was similar. And what happened with Madoff, we'll discuss in just a moment. But look at this jail sentence. So if you're going to be tried for fraud, the last place, yeah, that's a very good question. Are they illegal? Wow. So that's beyond my capability of saying. But what will happen is they will run out if there's no new investments coming in, or if the investments are being withdrawn. And look at the Stanford case. He was tried in the US, and you know, in the US, things are very, very severe by way of punishments. Then he got a 110-year jail sentence. The Ponzi scheme defrauded investors, and the defrauding aspect makes it, I guess, illegal, because you're promising people something that you can't actually achieve. You can't actually pay them what you're promising to them. And look at this, Forbes magazine estimated that Stanford was the 605th richest man in the world. But actually, he wasn't a rich person at all. You know, all his money came from the investments within the investment bank. See the final point there? We all love cricket in the Caribbean and in England as well, of course. In history, there were only two teams where the rivalry was really intense. One was the West Indies and the other was England. So the highlight was West Indies playing England. And of course, for many, many years, West Indies dominated and beat England quite comfortably. But more recently, England have managed to reverse things, but there we go. We'll see what happens next. I'm mentioning Antigua. In Antigua, there are two very famous cricketers, Ronnie Richardson, who is now Sir Ronnie Richardson, and then Vivian Richards, who is Sir Vivian. Now, how I know this is last time I was in Antigua, on the weekend, I went to the golf course in the north of Antigua, in the Cedar Valley. And when you look at the list of members, which is on the notice board, there's only about 80 members there, I think, and there's two sirs, and they're the two cricketers. So the problem for the cricket was that Stanford promotions were linking to, these cricket matches as well. Okay, now, before we move to the next one, the Madoff one, as I say, was different in that these were all top-end investors. And what happened with that one was in 2007, 2008, when the global crisis started, investors lost confidence. And that's what happened in the Madoff particular case. Now, the next one is one of the things in risk management that's probably really, really difficult to prove, and that's insider trading. And, if I'm standing or sitting rather in Senior Frog's bar in Nassau, Bahamas, and Miguel's with me, and I'm just talking to him, about some stock listed companies, and I've had this inside knowledge of something that's going to happen that will drastically affect the share price. If I tell Miguel about that and he acts on that information, is that insider trading? Anyone got a comment on that? Is that insider trading?
I would say it is, especially based on how you acquire the knowledge.
Yes.
So if you acquire the knowledge because you work with the account in question, definitely that would be insider trading once you disclose it to Miguel.
Yes, it is. Very good. Yes, it is very good, but it's very difficult to prove. So why is it difficult to prove? Well, because it could have been, just a conversation, and it's hard to prove that conversation existed. So these are difficult things to prove, the insider trading, as you'll see. Now, this one's closer to heart. Barclays Bank, Bob Diamond, the chief executive, were forced to resign after the bank came under pressure to remove senior executives over LIBOR rigging. Now, this is totally different. LIBOR is the London interbank offered rate. Now, this is like a benchmark rate on which lots of the banks in London will refer to in terms of their product pricing, interest rate strategies. And you have more of this under the market risk and financial instruments module number 4. But basically, it was proven that Barclays senior executives, including the chief executive at Barclays, had been actually rigging this rate. And I mean, if they were rigging the rate, what that means is the profits that they were actually making could be artificially inflated. So they were fined very heavily, 290 million, to settle with the US and British regulators. And Bob Diamond, who was the chief executive, was forced to quit. Now, don't feel too sorry for him, because look at the next news. Very shortly, Barclays' 4th major resignation. Allison, head of remuneration committee, outraged shareholders by approving Bob Diamond's 17 millions, that's about what, 24, 25 million US dollars pay package for leaving. So here's a man forced to quit, and yet at the same time, he's getting that huge amount of money, by way of a golden handshake. What do you think about that?
not much of a punishment.
That's a funny predicament. It's just whether or not that compensation package was in line with what's normal, whatever severance or whatever else.
Package was, yes.
Yeah.
Yeah, so that would have to be checked, but obviously it was a source of huge embarrassment, which forced the head of the remuneration committee to leave to devote time to other interests. So that was the reason that she gave on leaving. Now this, yeah.
So I was just going to say he might have appointed that person to the committee when he was in charge.
Yeah. Your mind's working like mine. Yes, he probably did. Yeah, he probably did. Well, certainly his immediate right-hand man, he definitely appointed. And these people were ex-Barclays Capital. What happened with Barclays Capital? Barclays Capital is the investment banking arm of the overall, huge Barclays group. And Bob Diamond came from the US and headed up Barclays Capital and made some, fantastic results, huge profits, which now we could possibly say are questionable. And then when the Barclays Group chief executive was retiring, because of Bob Diamond's record with Barclays Capital, he was appointed the chief executive. So that's a bit more of the background to it there. This wasn't just confined to Barclays. Look, February breaks news. London, this time it's the Royal Bank of Scotland, RBS, fined 390 million. Frankfurt, Deutsche Bank suspends 5 traders. And then Japan, there was claims of a cartel involvement in the Japanese rate. So again, as risk managers, I mean, this is going to be a difficult one. It's something that you might not even think of looking at. Where is the organization getting the guidelines on setting the rate structure? Well, hopefully it's clear directives, from your own central bank. Now here's another one, totally different. This is HBOS. HBOS stands for the Halifax and the Bank of Scotland. Now, just a little bit of background before we look at this. Halifax was a very successful, what we would call the building society. So it's an organization, financial institution that takes deposits from customers and they lend it out for property purchase, for domestic property purchase, which I think you would call real estate. So you're buying your own home. So their model is taking in short-term deposits, and then generally the loans are quite long, for people to buy their own domestic property, 10, 15, 20 years, sometimes possibly as long as 25 years. Now, Bank of Scotland, by contrast, are a commercial Scottish bank. So the Halifax is an area in Yorkshire, in the northwest of England, and Bank of Scotland are a bank based in Scotland, who are a commercial bank. Now, the coming together of these two banks, would that be a good idea or a bad idea? Any thoughts on that? So the coming together of a savings type of bank, lending out money long-term for mortgages and what have you, linked to a commercial bank geographically in Scotland. What do you think? Any comments? Any risk comments? Or any plus comments, these two coming together?
Can you highlight the backgrounds again?
Yeah, so Halifax, their business model being the same for years and years and years, take deposits from people like me and you and Miguel, and then they lend out for people to buy their own personal property, yeah? With mortgages of say 10, 15, 20 years.
Yeah, but Keith, mortgages have always been a safe venture because, I mean, the mortgage is standardized by the collateral. So yeah. Halifax seems conservative, and the Bank of Scotland seems very conservative. So, I mean, they have the same, they're under the same umbrella. So I think, with the right management, the combination would work. They're both conservative, and the risk profile seems to be low on both sides.
Right, great comment. Right management should work. Yeah. Now I'm putting that in the chat box because that's very, very important. Any two organizations coming together, one of the major risks is going to be the running of the combined organization. Yeah. And that goes right through all the things that we'll be discussing, during our risk management program over the coming months. So the leadership aspect, the senior management aspect will be very, very important indeed. And the chief executive will be very important. Now look, Sir James Crosby was chief executive of HBOS from 2001 until 2006. Now let me tell you, before that, his name was Jim or James Crosby, and he was knighted by the Queen for extraordinary results with this financial institution, extraordinary, really good results. But look at what happens. HBOS collapses in 2008. Now the lender of the last resort in the UK will be the Bank of England, but linked to the government directive, yeah? So in business generally, if a business is running into severe trouble and we're talking about a bailout situation, the bailout can have various parties involved. If it's a financial institution, the last resort will be going to the central bank, in our case, the Bank of England, and then seeing if the central bank, will offer a taxpayer bailout to save the organization. Now look at the extent of this. This is close to 30 billion US dollars to this organization. So what could go wrong? What could have gone wrong? Well, let's take our first case study look here. Now I'm hoping you can see this clearly on the screen or on your own notes that you've got there. And what I want you to do just for a few minutes is we'll be taking a break because we work for 1 hour, then we take a short 10-minute break, and we'll come back to this just after the break. So we're going to take a break in just 2 moments. But what we want you to do is to look at these figures in 2001, and then look at the figures in 2008, and then tell me when we come back and take some time after the break, what you think of these figures here from a risk management perspective. Okay, so let's take a 10-minute break, and then you can take a comfort break or make a cup of tea or coffee or whatever, and then we come back. 10 past, 10 minutes past. They are. Okay, thanks. Let's take a break. Okay, let's reconvene. I just want to check the sound is still there.
Yes.
Excellent, thank you. Okay, so we're going to look at this balance sheet in 2001 and then the progression of the balance sheet to 2008. So I just want you to spend, let's say, five minutes having a look at this individually and look at the figures that you can see, you know, thinking as a risk manager, anything catches your eye that you think could be risky or whatever. So 5 minutes.
For me, there seemed to be a sudden move into loans to international customers. And what came to mind was the level of due diligence or how well they knew those customers and how that was in line with their risk appetite.
Excellent. Who was speaking? Was that Shanta?
Yes, Ashanta.
Thank you. Yes. Okay, well, we'll just debate it instantly because Shanta started us off straight away. Yes, if we go down to the international section of this particular financial institution, you can see the customer loans, well, they've more than doubled. They've almost quadrupled, haven't they, from 14.4 to 61. So as a risk manager, a very good question Shanta was asking, how well do they know these international customers? Because credit's a difficult thing, you know, when you're dealing with it just domestically, but if you're now providing international loans as well, you know, what due diligence from the credit risk people have been done. So a selective risk target on that would be to look at that. Yes, very good. And what's happened then, Shanta, internationally at the same time on the international deposits? Well, they've increased, haven't they?
Yes, the international deposits increased, but not as much. The rate of increase was not as much as the rate of their lending to international customers.
Exactly. So you mentioned the risk side of how well do we know these international customers, but what does that imbalance cause if the deposits coming in or just over double, aren't they? Whereas the lending's going out at almost 4 times as much. What will that affect? Yep, brilliant. Liquidity misuse, excellent. Yeah. Yeah, very good. Okay, let's keep going then. So we'll just keep doing it as an open debate. So anyone want to pick on something else? Shanda's got us started in terms of the international side. You can either do it by microphone or put it in the chat box if you prefer.
But it appears as if the whole company has changed its aggressive position. It seems it has gotten more aggressive with loans, and really hasn't used the deposit inflow as a yardstick or as a control measure for the amount of loans it is willing to make. So it seems as if loans is its main goal. Yeah. And deposits really, you know, the balancing of deposits really is not really a consideration.
Excellent, thank you. So yes, if we look right at the top there, on the group basis, customer loans, 201 billion, and then increasing to 435. You know, anyone with a calculator handy or on your cell phone or on the computer, you will see what percentage increase that is. It's more than double, isn't it? Just looking at the figure. And then what about the corresponding customer deposits increase? So have a look at that as a percentage.
Well, it's a 216% increase, it appears to be.
On the loans,
on the
216.
customer loan, yeah.
So we're off at 216%. Anyone confirm that? And then what about the deposit increase? How much is that?
$158.2% increase.
What did you say? How much?
158.
158. Anyone confirm that?
You may want to put the 0.4% for the customer loans.
216, you said?
Yeah, 216. So at the 0.4, it makes a big difference.
And then on the other one,
The other
158.
one, 0.2.
Did you say 158?
Yes, 158.2.
Okay. Okay, so again, from the risk perspective, what does that indicate? So we're back to Bria earlier comment. Is this a liquidity issue again?
Yep.
Yep. Yep. So rapid expansion in the loan book, and then the deposits, the growth isn't the same. So we'll be expecting, yeah.
Can we just assume it's a liquidity issue? It could have been that they had stagnant funds that they were not appropriately using. To me, I think we would need to know the liquid assets that they had before we determine that it's a liquidity issue.
Correct. Yeah, we need deeper research, and that's always what happens in risk management. You know, we can look at things, form an initial conclusion, then we have to continue with our investigation, as it was. So on the other side of this, you can see the total asset growth is quite phenomenal there, from 274 to 630. So the balance sheet's really grown quite significantly. So can anyone give us that as a percentage? So 274.7, total assets increasing to 630.9. I'm going to get my calculator out as well. 630.
229.7.
229.7.
Yes.
So again, a huge growth in total assets. Now when we talk about liquidity and we talk about balance sheet growth and we talk about business performance, we've got a feedback on the mic. Somebody's left the mic on, please. That's it, we got it. The other side of this will be, you know, what's the equity position, what's the shareholders' funds or the net worth in the balance sheet as we described it last week, and I explained, you know, all the assets less the liabilities, giving you a personal net worth, or in business, all the assets less the liabilities, giving a business net worth. Now the business net worth here, look, is 9.823 in billions there, and that's gone to 17,792. So what sort of growth is that? And what would drive that growth in the shareholders' funds?
Profit can drive it?
Yeah, profitability. Yeah. So you can see this conflicting position, which we often see in business, and business people quite often have really difficult in understanding this, that they'll see profits coming through, but at the same time, the liquidity might not be improving. So, profitability that's generating, should generate positive cash flow is the starting point in any business, but that can be outweighed by other factors within the business, as we're seeing now. But you imagine the chief executive presenting to the shareholders, he'll be presenting good news, won't he? He'll be saying within the annual report and accounts, very pleased to tell you another year of outstanding profitability, and our net worth position has increased now to 17.8, whatever it is there shown on the screen. So how are they generating such huge amounts of profit? What do you think would be the main driver of the profits?
Interest income from the loans?
Yeah, definitely. Yeah, definitely. Thank you. Loans, the loans. So you've got fantastic loans growth, and provided, as was discussed earlier, these loans are good loans and progressing satisfactorily. This loan growth has got this huge growth in loans that we've seen, will generate in turn a huge growth in profitability, provided the credit portfolio is carefully managed, which will be Mike's topic with you on Module 2, Credit and Operational Risk. But we can see what's happening here. Now, let's see what other clues we can get to this. There we are. There's a good ratio. Loans to deposits. You won't often see this ratio quoted, but it's a good ratio to look at from a financial institution overall perspective. What's the loans relative to the deposit ratio? Well, you can see, that's got further out of line, gone from 143 to 196. So there's a big deterioration there. Now look at this next line. Does this give us a clue about the liquidity pressures? Wholesale funding of less than 1 year. So that's short-term money, from the capital markets, usually in the London wholesale markets. And what's happening there? They've got 89.8 of borrowings, generally overnight borrowings from the wholesale funding. And that's increased, hasn't it? So is that a good sign or a bad sign in terms of the liquidity?
To me, it's a bad sign. The wholesale funding is typically not short-term.
Yep.
And the lending most likely is long-term for these amounts.
Yes, so they're borrowing really we think, to balance up their liquidity shortfalls. So we're starting to get a number of things out of this. Now, the next ratio we're going to spend a bit more time on later, and I did mention it last week that the Basel Committee, were introducing this new backstop ratio, the leverage ratio, and we'll have another case study to look at where the title of the case is, is the leverage ratio necessary? Because of course, when the Basel Committee bring in new recommendation, there are always challenges to these things by way of the consultation documents. So leverage ratio, so that's the relationship of the total assets in the balance sheet to TSE, which is standing for the total shareholders' equity. And I mentioned this last week that if we're talking about leverage in a normal business, what we're looking at is all of the liabilities in the balance sheet. So that's the current and long-term liabilities. And we would divide that figure by the net worth of the business. And that would give us what we would call the leverage of that particular business. So that's not the gearing. Gearing is debt to equity, which is the liabilities carrying an interest charge. So we've got the gearing ratio, which is debt to equity. Then we've got the wider measurement of leverage, which is all the liabilities relative to the net worth. And obviously, the higher the leverage, the riskier the position is for the business moving forward. Now, with financial institutions, it's different because when we look at our balance sheet, the debtors in our balance sheet are the loans, yeah? So it's kind of the other way around. So what's happened is the Basel Committee have come up with this leverage ratio where you measure the total assets in the balance sheet, which need funding as the business progresses, and then measuring that against the net worth position. And you can see the deterioration from 29 times to 35 times leveraged. Anyone come across this ratio before, this leverage aspect? Anyone got anything on that? Well, we're going to progress the importance of this because this is, this is one of the key aspects under the Basel III directives, this leverage. Now, if you remember in the global crisis, Lehman Brothers in the US, very successful, we thought, investment banking operation, when they collapsed, they were 35 times leveraged. So they were generating huge profits, but the leverage was way out of line and they collapsed through liquidity pressures. So this is really another red flag. So just recapping on what we've seen so far, large increase in loans, smaller increase in deposits, huge increase in total assets, huge improvements in the net worth, we think due to retained profitability from the lending portfolio, from the loans, loan to deposit ratio getting worse, wholesale funding deteriorating, they're borrowing more money in the wholesale market, and then the leverage ratio, again, deteriorating up to 35 times leverage, quite a high leverage position. Retail, same sort of story, look, 132 up to 255, deposits not increasing as much. Corporate, again, corporate increasing significantly and deposits not increasing so much. International, that Shanta started us off with, loans increasing quite dramatically, deposits not increasing so much. And then we've got Treasury deposits position growing there. So overall, within this, there's a lot of warning flags that we're seeing. Now, what we want to know is, what happened after this. So what we need to do is, Miguel should have sent this to you, and if not, you can just go into the chat box there at the top of the chat box. And I hope can you see this on the screen? An accident waiting to happen. Anyone confirm they can see?
Oh, no, we
no?
can't.
No, okay.
I can't see, no.
No, okay, well, let me stop the screen sharing and then come up with this new share. Should be coming on the screen any moment. Have you got it now?
Yes.
Yes.
Okay, great. So this is HBOS that we are looking at. So this mysterious balance sheet figures that you were saying is actually, HBOS that we were discussing. It's a combination of the Halifax and the Bank of Scotland. And, one of the comments that came in within the chat box, you remember, was with right management, it should work. Yeah, well, with right management, it should work. So let's see what happens here. This is the failure. So HPOS fails, and this is a short extract from the full report of the Parliamentary Commission on Banking Standards. So this is a UK government report. If you want to read more about it anytime, you go on to, there's the reference there, www.parliament.uk, and you can make a search on the failure of HBOS. And I've extracted some of the key information for you to look at. So here we go. Look, HBOS was created in 2001 from the merger of Bank of Scotland and Halifax. Let me just move this across. Now, Halifax had been the UK's largest building society, so it's a huge organisation, and was one of the last of the major societies to demutualise and float in 1997. Halifax was almost entirely a retail organisation, as we discussed, leading UK mortgage and savings company, with a 22% share of mortgages and 16% share of savings. Mortgage. So next paragraph. Since 1970s, Bank of Scotland had followed a very successful strategy of organic market share growth. So that's growing, from within. The strategy combined maintaining its leading full service market position in Scotland with targeted expansion in England. Expansion involves segments that could be penetrated, etc., etc. Consequently, the bank prioritized areas such as high value mortgages and deposits, etc., going on, also commercial real estate. So point 13, Bank of Scotland continued to make gains in market share relatively successful. By the late 90s, BOS were considering a number of inorganic options. It made a hostile bid for the National Westminster Bank. So at the time, that was one of the leading banks in the UK, domiciled in London and the UK, National Westminster Bank, but ultimately lost its battle to the Royal Bank of Scotland. So what happened after that was for Bank of Scotland, a merger with Halifax offered potential of a significantly enhanced balance sheet. So just digressing for a second, what quite often happens if there's a hostile bid, which it was by the Royal Bank of Scotland to try and acquire the National Westminster Bank, quite often there'll be another bid that follows in, and this was the bid by Bank of Scotland trying to acquire the National Westminster Bank, but that failed. So their alternative strategy was to create this merger with the Halifax. So that's where the HBOS came into being. So BOS merging with Halifax. It also had relatively limited overlap. Halifax had little or no experience in corporate and treasury areas, whereas BOS, Bank of Scotland, was expected to provide the basis for the enlarged group. The creation of HBOS had the effect of turning the big four banking groups into the big five. At the end of 2001, HBOS had total assets of £275 billion, larger than Lloyd's TSB, 3/4 of the size of Barclays and of RBS. In its first annual report, HBOS described itself as the new force in banking. The new group saw an opportunity to benefit from its increased scale and from distributing its broadened product range to an enlarged customer base. It set out medium-term targets to achieve product market shares near the 15 to 20% that Halifax had enjoyed in its core markets. Now here's James Crosby. The Chief Executive, James Crosby, gave a public target for the new group to increase the return on equity from an underlying figure of 17%, which actually is a good return, in my opinion, to 20% by 2004. This increase implies the target, etc., earnings per share. The aim was to achieve this target through rapid growth across all divisions. HBOS essentially achieved this target with underlying earnings and a return on equity 19.8%. HBOS sustained significant business growth from 2001 to 2008. And then you'll see coming on the screen what you saw earlier, the figures I showed you earlier. This time they've got growth percentages in the right column. So this table underlines that in the period after its creation, HBOS pursued a strategy of asset-led growth, expanding its lending significantly faster than its deposits. Total group loans grew at a compound rate of 13% over the period, excluding impact, etc., etc. Do you have a question? No. Customer deposits rose 8% per annum during the same period. The growth rate of the loan book was faster up to 2004 than in the years from then until 2008. Growth problem I will discuss. Right. The effect of this growth in assets outstripping growth in deposits was to increase the bank's reliance on wholesale funding, the consequences of which we'll explore further later in this report. The board understood that the long-term growth strategy and that any strategy involving growth would entail a certain level of risk. For example, the board recognized the level of exposure to the UK residential and commercial property market. Despite pursuing a strategy of high growth with commensurate risk, HBOS preserved the self-image of a conservative institution. I'd be interested in your opinion on that. Addressing potential funding problems in a private letter to the chairman of the Financial Services Authority, Lord Stevenson wrote, "The common sense of the situation is that we're dealing with lenders looking to lend money to a highly conservative institution, less conservative than some, but certainly no more aggressive than many against which they're competing for business." So what do you think so far? Do you think they're conservatively managed organization?
No.
Definitely not. No, definitely not. I mean, those growths in the loan book were astonishing. And Sir James Crosby, the chief executive, the fact of the matter was that we did expand very fast, but the performance of the business in terms of its impairments and risk factors was satisfactory. I'm not sure I would accept that in the period up to 2005, we expanded too fast. Gosh. This was not an organization that was obsessed by growth or had a culture of optimism. You can go through the history of any organization and find decisions that looked overambitious. If you go through HBOS, you will find quite a lot of decisions that were quite conservative. So this is from the chairman again, Lord Stevenson. Now this is back to the UK Parliament's comments. The strategy set by the board from the creation of the new group sowed the seeds of its destruction. HBOS set a strategy for aggressive asset-led growth across divisions over a sustained period. This involved accepting more risk across all divisions of the group. Although many of the strengths of the two brands within HBOS largely persisted at branch level, the strategy created a new culture in the higher echelons of the bank. So these are the senior management. This culture was brash, underpinned by a belief that the growing market share was due to a special set of skills which HBOS possessed and which its competitors lacked. The effects of the culture were all the more corrosive when coupled with a lack of corporate self-knowledge at the top of the organization, enabling the bank's leaders to persist in the belief, in some cases to this day, that HBOS was a conservative institution when in actual fact it was the very opposite. Okay, anyone want to make some comments on what we've just seen?
I mean, it appears to be a very strange case, right? Because looking at it from the outside in, it seemed as if what the gentleman was saying was very, very true. I mean, the company did grow, but it in essence was a very conservative company, and really, just had a brand of growth based upon its new strategy of expansion. So it seems as if that it's more so much of a management failure or just not having the right people in place than the structure itself. But it seems as if I can't explain why this company would fail, because it seemed as if it was conservative, and then and based on its strategy, it increased in size.
Yeah.
So.
So why did it fail? Why did it fail?
I agree with Kevin's observation. I too think that the acquisition in itself, the merger, was not a bad thing.
Yeah,
but
correct.
Perhaps in merging, the leaders did not appreciate that they were taking on two different types of risk. And so they didn't put in place a new risk strategy in order to manage the new environment in which they were pursuing. So when the new leadership said they want 20% growth, we have seen in other institutions where you force growth on employees, employees tend to do different, the conduct change. So if you say to the employee, the senior manager, you put more pressure on them to perform, they tend to do more shady business. And so I think that when the gentleman was talking, I can't remember his name, about them
Crosby.
being Crosby, when he is referring to the organization as conservative,
I
believe he truly thought he was. Right? He probably thought he was, but he wasn't appreciating that the operations that he was now leading had become more risky and the aggressive targets that he had set.
Yeah. So we've got a total mismanagement right at the top. Yeah. So probably if we went visiting, the branches of the Halifax or the branches of the Bank of Scotland Bank, we talk to management, they probably are very good people, have been working in the business a long time. But as you say, what they've been set is very large growth targets without the risk strategies being put in place. And here's a business making huge profits. So why did they fail?
What I would add to that is not only failure of management, but failure of board and management, because the board should also consider the capacity and the competence of their management. Because if you're in a standard conservative type of operations for a number of years and you have not been exposed to the other aspect of business that you're considering taking over, what level of investment in these managers was done in terms of developing their capacity and their preparation for managing that type of risk. So I would include the board in this.
Well, most definitely, because do you remember that wheel diagram I showed you when we first started? Yeah, the wheel diagram, I had right at the center, if you remember, of the wheel was the board of directors, and setting the strategies. So definitely it's failure of the board and the senior management. And what type of risk brought these people down then? And you didn't mention
section of risk.
I'd say strategic risk.
Yeah, well, a strategic risk, but I mean the key risk was the liquidity risk, wasn't it? Yes.
Yes.
Yeah. So, this is a conundrum of business. You'll face this yourself. We talk to business customers and they're saying, oh, sales are going to be so-and-so, profits are going to be so-and-so. And then you try to steer them slightly in the opposite direction by saying, well, what about the cash flow aspects of the business? A typical conversation would be, oh, I've just got this new contract We're based in Antigua and we've got a new contract to supply St. Lucia with X, Y, and Z. And this is going to push our sales up by so-and-so, and the profits are going to go up by so-and-so. And then you have to say, yes, but what about the cash flow? Is the cash flow there? Is the liquidity there? Is the working capital there? You know, whatever type of terminology you think fits the conversation that you're having. But what we're trying to get at is the underlying cash flow of achieving this success. So this is very similar, isn't it? So what you've got is this financial institution pushing that product, huge product loan, the lending product, which is going to make huge profits, provided, you know, we know the customers and we've done the due diligence. But underlying that is how is this loan growth going to be funded? Now, it can only come from the customer's deposits or by getting liquidity from somewhere else, you know, maybe a new injection of capital from the shareholders, or maybe, you know, some other type of funding, which would point to the wholesale funding side. So it's the traditional conflict of profitability versus liquidity. And you know, you'll have a lot more on this in module 3, which is investment and liquidity risk. So you'll have a lot of work on this. But this is an astonishing case. So let me stop sharing that and get back, I hope. No, it doesn't come back. We're just having a short technical issue here. Miguel, I'm stuck.
Okay, did you stop sharing and reshare again?
I'm just going to try, yeah.
Yeah, stop sharing and retry again. All right, we got it.
Okay, great. Now what we're going to do is we're going to pick up on this senior management and particularly the board of directors, because you know, board of directors will feature very strongly in Christine Archer's presentation in module 6, which you'll find quite fascinating, talking about reputational risk and corporate governance issues. And Christine's very, very experienced at this. So what's happened here, as you quite rightly pointed out, is it's been, you know, gross mismanagement of the liquidity of the business. So this led, you know, to the collapse of the business from a liquidity perspective. And the only way, you know, so this was bailout or bust. You know, this is back to President Obama, bailout or bust. You know, General Motors, he bailed them out. Lehman Brothers, they didn't bail out and they collapsed. And same in the UK. So HPOS would go like cup in hand to the Bank of England governor, who in turn would liaise with the government to see if it was going to be bailout or bust, because the liquidity has run out, the cash flow has run out. In this particular case, because HPOS, you know, employed so many people, and HPOS was perceived to be, you know, a good brand in the marketplace, and the decision was taken, there would be a bailout of this very significant point. Now, what we're going to do next, just for the last 10 minutes or so, is we'll take a look at another case study, which is quite a famous case study, and that's the case of Barings Bank. And Miguel's going to assist us here by, I hope, putting you into for discussion groups just for a few minutes. So we'll just give you 5 minutes to have a look at the Barings Bank case study. It's quite a short case. And what we're looking for is your Barings Bank case won't open, Miguel.
Won't open?
No, it says it's could be damaged or different format.
Hold on 1 second.
Yeah. But can you put the good folks into 4 groups?
Okay.
And take a look at Barings Bank, particularly from the comments that you've been making, you know, in terms of senior management and the board of directors. So that's a clue to get you started. Will I try and get the Barings Bank case on the screen? So can you do the groups?
Yeah, so folks, I'm just going to randomly select you. So once you get prompted, just enter that room, select that room that you're going to be going into, okay?
And then have a look at Barings. What lessons can we learn about risk management from this Barings case?
Hi, Rolando. You see the link to click join? Just click on the link to join the room. There we go. All right. You got it there?
Can you see it, Miguel? Barings
Yeah,
Bank?
I can see it. I can see
Great.
it.
Great.
See if you could, well, I don't know.
Your picture's clearer now. Have you moved your hub near to you?
No, I just have, yeah, I don't think that stuff is on me. That's Cable Bahamas. Yeah, sorry, that's Cable Bahamas.
So when they're in groups, they can just talk to each other and nobody
Yeah,
else can hear?
they can talk to each other, but they can't hear nothing from nobody else.
Right, that's good. Is it easy to do that, to set them up in groups?
Yeah, just click on breakout room and click how many rooms you want, and then let them automatically choose.
Does it really?
Or you can manually do it.
All right.
Do it and then put them in the groups if you want to.
So where does breakout rooms appear on the?
Yeah,
on
if you go down to the bottom, share screen, you should see someone say breakout room somewhere down there. As co-host, you should be able to see it. No?
Well, at the moment I've got mute video, security, participants, chat, share, pause share, annotate, remote control, apps, and then more. Is it under more?
Yeah, click on more. You see breakout
Oh,
rooms?
yeah.
Okay. Yeah, so as co-host, you can do it as well. So.
And then you just click on there.
Yeah, you click on the breakout rooms, and then it'll ask you, you'll see the top how many rooms you want. And you just keep
it. Yeah, it says breakout rooms in progress, yeah.
Yeah. So how many you want, and if you want to sign them automatically or manually. Just do it automatically. You don't have time to click and push and choose people know what.
So they picked up lots of good points on the H-bus case.
That's good.
So we're going to run out of time. I think we'll have to leave the discussion on this until we meet again, you know?
Yeah.
We'll just give them a couple more minutes and then bring them back and then.
Yeah, bring them back in 4 minutes, exactly 12 o'clock.
Yeah. And we'll talk about it when we reconvene after Easter.
Yeah.
But you can see it okay on the screen.
Yeah, I can see it good. Very good.
Can you see that highlight in yellow now?
Yes, I can.
Right. So you off any of the time over Easter or not?
Yeah, I'm not doing it. No, I'm not going anywhere, but I schedule no classes, so we schedule classes during the Easter weekend because people, you know, they use that for. Good day, Miguel speaking. Oh, really?
What's happened?
All right, let me bring you all back then. Sorry about that. Let me bring you all back.
You bring them back now?
Yeah.
Okay, is everyone back now?
No, not yet. They should be in 1 second.
In progress.
Yeah. Okay, everyone. We had some technical. We had some technical issues there.
Was anybody able to discuss the meeting, the Barron's case, or no?
No, did not receive the slide.
Oh dear. Okay.
We apologize. Yeah, sorry about that.
Okay, look, what we're going to do is we're coming up to the magic hour of 12 o'clock for you and 5 o'clock here in the UK. So what we'll do is, you know, I hope you enjoy Easter break over the Easter weekend. And if you could just do a little bit of homework, you could take a look at the Bearings case. And what we'll do is when we reconvene on Saturday, April the 23rd, we'll start off by talking about the Bearings case. So have a look at the case. Very interesting case, you know, because you can see on the screen now, I hope, Bearings Bank had a long history of success. One of the UK's oldest merchant banks.
I can see.
Yeah, but they they were bankrupted by 1 billion of unauthorized trading losses. So again, a huge impact of this risk on the organization. You know, the organization ceased to exist, as you'd see when you read through. So what I want you to do is read through it during the break and then make yourself a little list. What lessons about risk management can we learn from this example, this Barings Bank example? And you'll see it picks up on some of our discussions of the board of directors and the senior management. Okay, well, thanks very much for attending, and I hope you all have a good Easter break, and we will see you April the, what did I say?
April 23rd.
April 23rd on Miguel's list.
Okay.
All right, take care.
Thank
All right,
you.
good day.
Thank you.
Thank you.
Good day. Bye-bye.
Good day, everyone.
Have a good day.
Good day, good day.
Thanks for your participation. Lots of comments. Very good.